Welcome back, smart investors. This channel is built on one simple, powerful idea: long-term investing. Remember this phrase: buy the time, not timing. In this video, we're going to break down exactly what this means and how embracing this philosophy can completely transform your investment returns. So, what are we really doing when we buy a stock? We're not just buying a ticker symbol or a fluctuating price on a screen. We are buying a piece of a business, a claim on its future value. But here's the problem. Most individual investors get this backward. They obsess over the daily ups and downs, the red and green numbers flashing on their screens. They get hypnotized. And to make things worse, countless YouTube channels fuel this frenzy. They dramatize every little market twitch, telling you to react instantly, to buy now, sell now, switch, panic. It's pure chaos. The result? Every day, people get sucked into the whirlwind of short-term trading. They get tossed around by market waves and end up fighting a losing battle against the market itself. Let's ground this in reality with some real numbers. Take a look at Apple. Imagine you bought just one share of Apple back in early 2005 and simply held on. As of today, your investment wouldn't just be up. It would have exploded by over 20,000%. Now the magic here isn't just the stock price climbing. The real secret sauce is stock splits. Apple executed 3 major splits in that period: a 2-for-1, a 7-for-1, and another 4-for-1. Each time, the number of shares you owned multiplied dramatically, without you lifting a finger. This is the incredible power of long-term compounding in action. When you own the business value, your life can change. When you chase the price, your returns simply vanish. Now let's zoom out and look at the entire market, using the S&P 500 as our guide. According to data from top asset managers like JP Morgan, BlackRock, and Fidelity, the story is incredibly consistent. Over the past 20 years, the S&P 500 has delivered an average annual return of around 10%, assuming you reinvested the dividends. That turns your initial investment into 8 times its original value over 2 decades. This isn't luck. This is the reward you get for simply staying in the market. But here's where the numbers get truly shocking. If you tried to time the market and missed just the 10 best days over those 20 years, your average annual return would be cut in half, dropping to about 5.6%. What if you missed the 20 best days? Your returns would collapse by more than 70%, down to a measly 2 to 3% per year. And here's the kicker: most of those best days happened right after the worst market crashes. Think about that. If fear pushes you out when things look bleak, you will almost certainly miss the most powerful rebounds. Your lifetime returns will evaporate. It gets even more extreme. If you remove just the best 20 weeks from several decades of S&P 500 returns, a massive 278% gain flips into a negative 1.3% loss. This is the cruel, unforgiving math of market timing. The market is won by time in, not by timing it. So why does the market tend to rise over the long term? Why does the index chart always seem to point up and to the right over decades? The answer is structural. It's built right into our economic system. When economies slow down, governments and central banks step in. They expand the money supply to stimulate growth. Simultaneously, social welfare spending increases and national debt grows. All of these actions gradually chip away at the real value of cash. It makes debt cheaper and pushes the economy forward. As the supply of money expands, where does it go? It flows out of savings accounts and into assets, stocks, real estate, gold. This is the fundamental engine that drives asset markets higher over time. From a company's perspective, this process, often driven by inflation, looks like this. First, prices for goods and services go up, which means company revenues rise. Sure, their costs also go up, which can squeeze profit margins in the short term. But the market looks ahead. It sees the potential for higher future earnings and starts pricing the stock higher. Over time, the actual profits catch up. The key takeaway is this: revenue leads, stock prices follow, and profits eventually arrive. The market doesn't price the past. It prices the future. This brings us to a critical question. Does this mean every stock is a winner if you just hold on long enough? Absolutely not. Long-term investing isn't about blindly holding onto anything forever. It's about holding the right things for a very long time. If you're picking individual stocks, you need a strict checklist. Look for companies with clear industry leadership and significant scale. They need strong market share and brand power that customers trust. Their future revenue and cash flow should be predictable. And most importantly, they need durable, long-term advantages, things like superior technology, a locked-in ecosystem, massive amounts of data, or powerful network effects. Without these qualities, long-term investing just becomes long-term risk. This is precisely why so many successful investors choose to buy the market itself through broad index ETFs, like those tracking the S&P 500. This strategy eliminates the risk of a single company failing while allowing you to capture the full upward momentum of the entire economic system. So the conclusion is simple and powerful. We aren't just buying stock prices. We are buying a share of future value. And the global economy is structurally designed to push that value higher over time. Factors like an increasing money supply, inflation, national debt, welfare expansion, and technological progress all work together to lift the market in the long run. Short-term traders exhaust themselves chasing fleeting prices. Long-term investors position themselves to own the future. This channel exists to share and celebrate the value of long-term investing. If you share this vision, please subscribe, like this video, and I'd love to read your thoughts in the comments below. Thanks for watching.